bad. Okay. Thank you for joining me. My name is Jonathan Hughes, and this is MEFA's Saving for College presentation. This should run about 45 minutes or so, and this is being recorded, so everybody who registered for this presentation will receive a copy, a recorded copy of this presentation, as well as the slides. So let me get going here. I'll share my screen. And I'll get started. As I said earlier, my name is Jonathan Hughes. I'm the Associate Director of College Planning and Content Creation at MEFA. I've worked at MEFA for over 20 years, helping families in Massachusetts to prepare for college. And, I work pretty intimately with the savings programs, the U Plan and the U Fund that we're going to go over in this presentation today. And savings is probably my favorite thing to talk about because you get to help people do the most constructive thing that they can do to prepare their kids for college, which is to save for them. And it sounds like somewhat of a platitude, but it really is true that when it comes time to use the money and talking with families at that point, you do really realize that nobody regrets saving. Everybody's really glad that they have saved what they've been able to save, even if that's only a little bit. And that's something we're going to talk about a little bit later on. The first thing I want to do is talk about MEFA, which is the Massachusetts Educational Financing Authority. We were created back in 1982 by the Commonwealth of Massachusetts to help families to plan, save, and pay for college. So we are a resource for you throughout this entire process. This is families with very young children to families who have students in high school getting ready to go to college, to students who are in college, and graduates getting ready to refinance their loan. So we have a lot of free content that's available. So we help Massachusetts families, we help all families really to plan, save, and pay for college. So we're going to talk about saving here tonight. We offer fixed interest rate loans as well for families and students to attend college. So that sort of takes care of the paying part. And the planning part is also kind of what we're doing here today. We do a lot of guidance. We have a lot of tools, tips, resources for free on mefa.org, our site. We have a bench of college guidance experts that you can call, you can email, you can connect with us over social media, and I'll give out that information by the end of the presentation. All the guidance that we offer is free. Everything that we offer is free except for the loans, which obviously you have to pay back. But what I'm really driving at when I'm talking about all this is that if you're starting to think about saving for college now, you've got a lot ahead of you before you get to paying for college and sending your kids to college. And we are here as a resource for you at any time throughout that process. So please don't hesitate to contact us in whatever way is convenient for you. We're going to talk about a few things tonight. The first thing we're going to touch upon is why saving is important. So why save, including dispelling some myths about saving that are really important. We're going to talk about two specific college savings options. Those are the programs that I just mentioned, the U Plan and the U Fund, which are offered by MEFA. I'm always careful to say that whatever way that you can save is a good way to save. So the way that you do save is the best way. However, there are some ways that carry special or specific incentives or benefits to them when used for college. And so there are some ways when specifically used for college that may go a little further than just sort of bank account savings. And that's what we're going to talk about. We're going to talk about strategies for saving. So what have families done? What have students done? What have parents done in the past that have helped them to save, that we know helps families to save? So we're going to talk about some of those things. And then finally, I think it's a good thing to wrap up with, to give you an understanding how families actually pay for post-secondary education. There's two things I want to say about this bullet. The first is how families actually pay for college or post-secondary education is probably the most common question that I've received over my 20 plus years at MEFA. When you boil it right down, most people who are getting ready to send their kids to college or getting ready to go to college want to know, how do people do this? So we'll talk about some of the ways that they do it. Secondly, I say post-secondary education. What I mean by that is whatever comes after high school. So college is part of that, but also career training or right into the workforce may be the path that you or your student may take. And the idea is not that everybody has to go to college, right? It's that whatever you're going to do after high school, whatever you're going to do for your career, you want to have a plan, you want to be in a good position to succeed there. So we'll talk about that. Okay, first question. Oh, one thing I'll say, if you do have any questions, please put them into the Q&A. And if I get any questions throughout, I can answer them. I'll also be here afterwards in case anybody has any questions. So the first thing that we're going to talk about are some myths that we've heard about saving for college. And I put this right at the front because it really is probably the most important thing that I want to leave you with. So myths we've heard about saving for college. The first one being, my savings will hurt my financial aid. I cannot tell you how many times I have had this conversation with families, with parents, where they say, yeah, but if I save, aren't they going to look at that and say, well, you don't need any financial aid that I'm going to give you? The truth is, no, it won't. There are two ways that financial aid can be awarded when it comes time to apply for financial aid when your student is a senior in high school. And those are merit. So those, think of things like academic scholarships or athletic scholarships. Those scholarships are awarded based on something that the student has done. So recognition of student achievement. It has absolutely nothing to do with how much you make or how much you've saved. It is true that most financial aid is the other kind of financial aid, which is need-based financial aid. So not merit-based, but need-based. So things like grants, things like subsidies on federal student loans, those things are assessed on your economic situation. So that's student income, student assets, parent income, and parent assets. So if you are a parent saving for college and you have a dedicated account maybe, or any account really to save for your kids for college, that is going to be assessed as a parent asset, and that may affect your financial aid, but pretty minimally, and certainly not in many cases with any weight, and certainly not coming close to counteracting the value of actually having the money. So I want to talk about it, but it's hard to get into financial aid calculations without getting really detailed and in the weeds. But basically, they're looking at, as I said, the four main pillars: student income, student assets, parent income, parent assets. Students tend to not have a lot of income or assets, so that goes out. Parent income and parent assets are mainly what determines your financial need for financial aid. And the vast majority of the weight there is going to be placed on the income and not the assets. The second thing that we've heard is that it's not worth saving for college if I can't save the entire cost of college. Well, not many people can save the entire cost of college. The fact is that very few families will have to pay the entire cost of college. There is financial aid available. The vast majority of families will qualify for some level of financial aid. So everything that you save, you're going to factor in aid first, and then whatever your balance is left over, if you have some savings, that can possibly cover that balance, or at least make it so that you don't have to borrow that full balance. So everything that you save is something that you don't have to borrow. Now, somebody has a question here. Is it true that 529 money can be rolled out into a Roth IRA of the child if it's not in use? Very timely question there. We'll get into 529, the specifics of 529s in a minute. I will answer your question that is a new regulation that was passed. So as of 2024, there are some stipulations where you can roll money out of a 529 into a Roth IRA for the beneficiary. there are some wrinkles with that, and you want to talk to your 529 plan holder, whatever company that is, about that, because there are some guidelines as to, you have to have the 529 plan in existence for 15 years, for example, to do that. And I believe you can't use any money that you've contributed within the last 5 years. So there's some policy guidelines there, and there's some regulations as to when and how much you can transfer over. But that is something that is a new change that will be allowed somewhat in some cases, if that answers your question. But thank you for asking it. So in short, the message that I want to leave you with here is that your college savings will help you. As I said, nobody that I have talked to has ever regretted saving for college. If you have some money saved, it's just the best thing that you can do by the time you're getting to actually filing financial aid forms and applying for colleges. It can put more college options on your list. If you know that you have this money saved, it may help you to actually fill out these applications. The biggest thing for me, it will reduce or eliminate, hopefully even, the need to borrow loans. The fact is that, many, if not most families at least, will be borrowing something to get through 2 or 4 or more years of college. Having some savings, though, can really help alleviate the burden of those loans. Allows the student to work less and study more, and it has a minimum impact on aid eligibility. The other thing I want to say, too, is that there's been a lot of studies done on specifically 529 plans that show that regardless how much you actually have saved in the plan, even if it's below $500, that has an outsized impact on students' rates of college attendance and college graduation. So if a child knows that money is being set aside for them in a 529, they are, I believe, I may get this backwards, but I believe it's 3 times as likely to attend college and 4 times as likely to graduate. And that is across income levels and across, as I said, savings levels as well. So even with very little money, that is the case. So your college savings definitely will help you. Now, talking about 2 specific savings options, I've already mentioned 529 plans. 529 plans have in recent years become sort of the college savings vehicle of choice, probably the most well-known college savings vehicles in the country. The 529 plans themselves were created in the late 90s at the federal level, and then each state was sort of tasked with setting up and operating their own 529 plans. And so the Massachusetts 529 plan is called the U Fund. It's a MEFA program that we offer in conjunction with Fidelity Investments. And so this is how it works. You open up a U Fund account and you put money in the account, and that money is invested by Fidelity. It's invested in the market, and it grows with no taxes on the earnings. So it grows with the market, tax deferred. When it comes time to use the money, as long as those funds are used for qualified education expenses, then you pay no taxes on the earnings. So it's a tax-advantaged way to pay for education. So what are qualified education expenses? They're things like tuition, fees, food, housing, books, supplies, and equipment. And just because you're in the Massachusetts plan doesn't mean that you have to go to college in Massachusetts to use the funds. It's good at any accredited college or university nationwide. It actually works for colleges outside of the country as well if they are set up to take U.S. federal funding. So there's a lot of variety in where and how these funds can be used. In fact, it doesn't even have to be used for a college per se. These funds can be used for training programs or career training programs, as long as, once again, the institution itself, the school, is eligible to take U.S. federal funding. So again, a wide variety in how this can be used. The combined account maximum cannot exceed $500,000. So if you have an account that has over $500,000 in it, you're not going to be able to put any more money into that. good problem to have if you have it. It's not something that most people run into. The one thing that is important to most people, there is no annual account maintenance fee, meaning there's not a fee that you're going to have to pay out of pocket as part of this plan. There are fees associated, but they come out of the earnings on the investment. The other thing that's important, there's no minimum investment to get started. Time was there used to be a $50 minimum investment to get started in the U Fund, but there's none anymore. So you can open an account with $15 or $10. You can open an account with no money with the plans on funding it later. We really just want to eliminate any obstacles that may exist for people to start saving. We know starting saving is the hardest part. So once you're over that, it's much easier to continue. And finally, it says multiple investment options. So this is an investment plan. You put money in, it is invested. We at MEFA here, I certainly am not an investment advisor. I'm not an expert in investment. I really don't know anything about it. But Fidelity is, and they can advise you on investing. They can get a feel for your risk tolerance, your comfort level with dealing with certain types of investments, and they can sort of advise you accordingly. And they are, I'm happy to say, very helpful and very available. You can call them. There's the phone number, 800-544-2776. They're available. I believe it's 8 a.m. to 7 p.m. And so I always tell this story. The first time I was opening my account, I was able to call. I had some question. I was able to call at 10 a.m. on a Saturday and get somebody to help me with my question. So I'm very pleased to be able to sort of personally vouch for them. But they're terrific partners of ours, and you know, I can't stress their availability and their helpfulness enough. And so the other thing is, if you pick an investment option and then you find out later that you want to change it, you're able to do that as well. So, but they really should be your resource for any sort of investment questions, of which there are really not many on the form. There's one or two, but they do have to be answered before you're setting up an account. So that's how the U Fund is designed to be used. But what if, things don't quite go as planned? So what if you set up your 529, your U Fund for your child or for your student, and they don't end up going to a college? Well, first thing I'd like to say about that is, want to stress once again, the U Fund can be used for vocational training programs at eligible institutions. So it's not necessarily the case that it has to be used for college. Secondly, the funds can be transferred to another beneficiary within the family. So if you have more than one child, or if there's a cousin or something that could use the funds, if the original beneficiary doesn't end up using them, you can transfer that over. So that is an option. What happens if my beneficiary goes to graduate school? If you're lucky enough that you still have funds in your 529 account after your student graduates from their their undergraduate program, and they're moving on to graduate school, they can use 529 funds for that as well. But if you do have to cash funds out of your 529 and use them for an ineligible expense, well, then you lose. There are penalties associated with that. It is important to say that they are associated with the earnings on the account and not with what you put into it. So your contributions are not going to be penalized, just the earnings on that. And there's two parts of that. So there's a 10% penalty on the earnings. And then the earnings will be taxed at the owner's rate of income. So you lose that tax benefit if it's used in a way that it wasn't designed for. There are 3 exceptions to paying that 10% penalty, 2 of which we don't really want to dwell on too much. So that is death and disability of the student. So there is that option. But the third is scholarship. So if the student earns a scholarship and you had to take money out and you can't use your 529 funds in the way that they were intended because of that scholarship, then you don't pay that 10% penalty on that scholarship amount. But even in those 3 cases, the earnings will be taxed at the owner's rate of income. Question here is, can you submit what you think would be eligible and see if it would be approved? So the way it would work, I think I think what you're asking is, can you ask, can I use a 529 for this? Would it be eligible? You can talk to the plan holder, in our case, Fidelity, about that. But it's important to know the mechanism on this is on the back end. So if you take money out and you use it however you use it, if you're audited by the IRS, you have to be able to show, I use this 529 money for a qualified educational expense. Now, you can have this money sent right to the college, or you can cash it out to the owner. But if you cash it out to the owner, you need to make sure that you can document that I use this to pay these expenses. So I use this to pay for books. Or I use this to pay for food and housing, or something, tuition, whatever it may be. So you wouldn't submit it beforehand. That's just not the process. You just have to be able to document how you used it. But if you have questions about how something could be used, you could call, and if you have a U fund, you could call MEFA, you could call Fidelity at that time to get a feel for it. And of course, as in all tax related questions, your tax preparer should be consulted. That he should really be the ultimate authority there, he or she. There's been some expansion in terms of 529 qualified expenses. So 529 plan funds can now be used for textbooks, fees, and equipment for apprenticeships, and that's up to $10,000 a year can be withdrawn and retain that tax benefit for those types of expenses. Same thing, $10,000 annually for tuition at private and public K through 12 education, and a one-time $10,000 disbursement can be taken for a student loan repayment. So this is an expansion of qualified expenses. And I should say that, over the life of the 529 program, the trend has been towards more expansion, more use, more ease of use, and more benefits. So this is another example of that. The other program that we have, which is quite a bit different than the 529 plan, the U fund, is the U plan, which is the prepaid tuition program. This takes a bit of explaining, but it is a really good plan. I like this plan a lot because we used to work, I said Fidelity manages the investments for the U fund. They also manage the accounts. So when I call up about my 529, I'm getting the U fund. I'm getting Fidelity on the phone, and they're telling me about my account. Well, we spent many years in MEFA internally servicing the U-Plan account. So when people would call up about their U-Plan accounts, they would get me, or they would get my coworker. So I know a lot about the U-Plan, and I really like the U-Plan, and I'll stop talking about me now and talk about the U-Plan. Basically, this works differently. It predates the 529 plans. So this has been around since 1995. And the point of the U-Plan, it allows you to prepay up to 100% of tuition and mandatory fees at every participating college. So that right away is a couple of differences in the U fund. It's designed to work at colleges which are part of the U plan. So a large network of Massachusetts public and private colleges, so over 70 colleges and universities, all the participating colleges are in Massachusetts. And so the way the plan works is you open up an account. Again, like the U fund, you can open an account at any point during the year. You can put in a lump sum. You can have money automatically withdrawn every month or so, however you wanted to do that. And the money for the U plan is actually not invested in the market. It's invested in bonds that are backed by the full faith and credit of the Commonwealth. And those bonds accrue interest at CPI, Consumer Price Index. But that's not the point of the plan. The point of the plan is, depending on how much money you put in, you're buying a percentage of this year's tuition at each participating college in the plan. So let's say I put in $1,000, make the math easy for me. So that $1,000 is going to buy 10% of tuition at a college that costs $1,000. I'm sorry, $10,000 this year. it would buy 3% of tuition at a college that costs $30,000 this year. Every college has a different tuition and fee figure. So whatever you put in is going to buy a different percentage at each college. You don't have to pick the college when you put the money in, only when you're getting ready to use the money, when the child is going to college. I'll talk about what happens if they don't go to a college on the list in just a minute, because I know that's the big question. But okay, so let's say by the time the child ends up going to college, they're going to that first college. So you put in $1,000, you bought 10% of tuition because tuition costs $10,000. Well, when the child goes to that college, it's now $25,000. But you've got 10% of that. So you got $2,500 because you bought 10% of tuition and now 10% is worth $2,500. That's essentially how the plan works. So you're prepaying a percentage of tuition, and that percentage varies based on the college and how much you put in. There is a $300 minimum to buy a U-Plan certificate. So you don't have to put $300 in right away, but the way it works is there's a bond purchase every year. So we take all of the funds that we got from your account throughout the year before that. If it's $300 or more, you bought a U-Plan certificate. If it isn't, then it stays in the account, and maybe if you have it next year, you'd buy a U-Plan certificate. That is essentially how the plan works. Now, every year you can continue buying. So let's say you put in $1,000 this year, you bought 10% of tuition at that particular college. You put in $1,000 the year after that. Tuition's gone up a little bit from last year to this year. So your $1,000 doesn't quite buy $10,000 again this year. It might buy 9.5% of tuition. So, now you've got 19.5% of tuition for the child's freshman year. So, you can keep adding to your percentage that way. When you're putting money in, you designate how much you're putting in and for what year or years. So you want to pick one or more maturity years, one or more year that the student is going to be in college for. And you lock in that percentage of tuition for that year. So you can continue to do that. There is a 5-year minimum, though, between when you put money in and when it can mature. So if your child is already in high school, you might be sort of running out of time to do this. This works best for younger students than that. Now, what happens if your child doesn't go to a participating college? I know that's a big question, because people get really hung up on this. I can't do this because I don't know where they're going to go to college. And I understand that. But if that happens, well, again, like the U Fund, you can transfer those funds over to another student if they can use the funds, or you can cash out and get what you put in plus the interest back. So you get what you put in plus the CPI interest. There are no, it's our bond council's opinion that there's no Massachusetts tax penalty for cashing out, so you don't have to pay taxes on that for the state of Massachusetts, also federally as well. If you live in another state, they may have other tax laws that I'm unaware of, so check with your tax preparer there. But just to give you that knowledge, because I think people get worried about that as well. What happens if my beneficiary goes to graduate school? So this locks in only for undergraduate degrees, not for graduate school programs. But again, if you have money left over, you can always cash out and get what you put in and plus the interest and use that for graduate school expenses. So that essentially is how the U-Plan works. And there's a lot to say about the U-Plan. So I think, for a while, I know I went through this. I didn't want to think about it too much because I didn't understand it. And but once I did understand it, I really grew to like the program, and especially when I saw people's accounts when they were using funds, especially if they started a program really when their child was really young and they ended up going to a participating college, with the rate that that tuition has increased, a lot of people did quite well. That was my experience. That's every case is going to be different, but I really, as I said, grew to like the U-Plan. So if you have any questions, again, you can reach out to us. You can visit us on the website for that. I'll be happy to answer any questions about the U-Plan now or after the presentation. I wanted to just close here on our savings programs by talking about the Massachusetts tax benefits for saving in the U Plan and the U Fund. So you can deduct up to a certain amount of your contributions on your Massachusetts state income taxes. So you can deduct up to $2,000 of your contributions against your income on your Massachusetts state taxes. That's up to $2,000 for married filers filing jointly, or up to $1,000 for individual filers. And those limits are per filer, not per account. So if you're filing Massachusetts taxes and you're claiming some of these, those are your set limits: $2,000 if you're a married filer filing jointly, or $1,000 for an individual filer. This is something that many states do, and Massachusetts was a little bit later to add these bonuses or benefits, really, incentives to save. But we're glad that they did, obviously, and we've seen people take advantage of that. So just another benefit of you saving in these programs. I also want to mention the Baby Steps program. If you've not heard of this program, again, another one that we're really excited about, that we've seen other states and municipalities sort of do. And when the word came down that the state treasurer wanted to implement a program like this in Massachusetts, well, I can tell you that I was really happy about that. Basically what this is, it's Massachusetts's first statewide seeded college savings account plan, child savings account plan. And basically what it does, sets aside $50 for every child born or adopted in Massachusetts in a U Fund account. So they have 1 year from the first till their first birthday, or the first anniversary of their date of adoption, to open an account and claim that $50. And that's been the case since January 1st of 2020. So if you know somebody who is about to have a baby or just had a baby, maybe eligible for baby steps, if they're born in Massachusetts, or parents in Massachusetts, then all they need to do is sign up for a U Fund account, and they will be seated in $50 from the Baby Steps program. And then they have that money, it's theirs. They can add to it if they want. They don't have to. Hopefully this will grow and accrue value, and they're able to use that. So that is something that we're really excited about. And it kind of feeds into our strategies for saving, because one of the reasons that we start at birth for the Baby Steps program is that we know that starting early really does pay off. So start saving as early as possible. I would never say that it is too late to start saving, truly, because anything that you save, as I said earlier, is something that you don't have to borrow, right? So even if you're a year or two out, put some money away. That can go towards a payment plan when you're in college, or some 529 account to use for some expenses. But kind of like retirement, it is to your advantage to save early, right? And we have a slide on that on where you can see the sort of benefits of that. We'll get to that in a minute. Start with a goal in mind. We have more information on that as well. Starting with a goal is always great, but don't let not having a goal prevent you from starting, right? So just save whatever you can. Just open an account and save whatever you can. That's what I did when I first started, and just, wasn't able to save very much on a monthly basis, but glad I was able to save what I did. Taking advantage of unexpected funds, so tax refunds, anything that you're not expecting, you might save it in a 529 or in a college savings account. You may save half of it. Using automatic transfers is a big one. I mean, we know that people who get money automatically deducted either from their paycheck or from their checking accounts tend to save more than people who don't. I can tell you from my own personal experience, both using automatic withdrawal to pay my loans and also to save for 529s. Was a huge help. Again, I always tell this story, but when my son was born, we opened up a 529, and about a year into his life, I said to my wife, "Oh, we really have to start putting money aside in the 529." She told me that we actually had been doing that for about 10 months. I just didn't notice because it was coming out of my account and I didn't even see it. So, not that uncommon. We know that this is an effective way to do it. Another really effective way to grow savings is to get the word out to your family and friends to contribute. So this is something that, relatives, family, friends like to do. And as parents, it's wonderful, especially when you have a younger child. This image here is on the right here is of a gifting page. Fidelity sets up a gifting page if you have a U fund, and you can create this with the image of your child, the year that they're going into college, and some dreams that they have. And then you can just create a link and email that link out to family and friends, and they can gift money directly in. So that's a great thing to do. They also make it very easy. People can just send in checks to the account. They have a mobile check deposit option on the Fidelity app. So if you have that, like I would sometimes get a check from my aunt for my son's 529, and you just take a picture of the check and mobile deposit that in. So it's very easy, and we always like to talk about that because it really is an effective way to grow accounts. And then involving your child in the process. So that always, I'll be honest, seems really optimistic to me, but I do know people who've done it. And, I remember speaking with a financial aid director of college who said she made her daughter save half of everything that she got for birthdays, first communions, whatever milestone it may have been, in her 529. So not only did that help grow her 529, but it also became a habit for her to continue throughout the rest of her life to save half of what she got, right? And we always talk about that as a good practice, to pay yourself first. I want to take, we have oh no, okay, we're good. So I want to take this opportunity here to look at our college planning tool. So I've talked about starting with a goal in mind and how we have a tool to help you determine what that might be. And so I like this because this answered a question that's really hard to answer. I would get calls sometimes from particularly the parents of really young children, like newborns, and they would be really gung-ho about this and say, I want to pay for college. I want to have college paid for my daughter or my son by the time they get there. What do I need to save every month? And that's a really hard question to answer, right? It's almost impossible because there's just a lot of things we don't know, right? We don't know what college they're going to go to, which makes a really big difference. We don't know how much financial aid you're going to be eligible to receive. So don't know what your bill is going to be. That makes a big difference. So it's hard to say. But this is a tool that we have that can help you to get an idea and answer some of those questions. It's all estimates, of course, but it can help. What you can do is go onto the MEFA College Planning Tool, create a profile for your family. And when you're doing that, you're going to put in information like how old your son or daughter is. And it's going to calculate, of course, by the time they get 18, it should be this year. And based on tuition increases at different types of colleges or different colleges, this is what tuition is likely to be at this college or this type of college. So you can search colleges and put them into the calculator. You can search types of colleges and put them into the calculator. And you can see here, this upward graph, unfortunately, is the tuition cost. You can also project. You can say, this is how much money I have saved, or this is how much money I will save every month until then. And then it will estimate by the time your child is 18, based on a certain rate of return in the market, which you can also customize, how much money you are likely to have saved by the time you get to that college. So we have what tuition is likely to be, how much you're likely to have to pay for it. And the final piece, if you put your income in, it should give you, it will do an expected family contribution calculator, or it's now a student aid index calculator, to give you some idea of how much financial aid you may be eligible for, at least gift aid. And what gift aid is grants and scholarships. So not including loan, not including work studies. So grants and scholarships, the money you don't have to repay. And so in this, and then it will, so, okay, I want to draw your attention to this image here. So it says here, the cost in this particular example, and this is by year, should be about $60,000. the family is eligible, based on the calculations, for about $7,000 in gift aid. And based on the rate that they are saving, they're going to have about $32,000 to pay for college. So that means it's going to cost them about $60,000. They're going to have about $40,000 to pay, which means they're looking at almost a $21,000 shortfall. So this may be a loan that they take out, or a loan may be part of that $20,000, but they know, based on the shortfall, how comfortable they would be financing that, and financing 4 times that if it's a 4-year college. So they know they need to either bump up their savings, start applying for scholarships. It's just something, you can search for colleges on scholarships on the site as well. Look at some less expensive colleges, some combination of those 3. And, this is something that you can keep an eye on, and there are different levels. Every year you complete certain tasks. So it's comprehensive, and it can be really, really helpful. And it does a lot of other things too, but that to me is the heart of it. Now I want to show you just a little bit on saving early and the importance of saving early. And specifically, this illustrates the principle of compound interest, right? And so compound interest it's not just what you're saving. It's the interest that gets accrued on that. And compound interest is actually interest gaining on interest. And which is how it works in 529 plan. So your interest is actually gaining interest as well. So that can really, if you're saving long enough, have an outsized impact. So in this example here, we have Julie, who is saving $50 a month in a 529 account, but she starts when her child is first born. Whereas Jonathan saves $100 a month, but I don't start until that's me. That Jonathan, I believe, is me. I don't start until my child is in 2nd grade. So I'm 7 years later than Julie, but I'm trying to make up for it. So I double my contributions, right? So who's going to have more money by the time their child turns 18? The answer is Julie. Even though I'm doubling, because when she starts saving, she's putting $50 in. She's going to contribute $10,800 and gain almost that exact amount in interest and have about $21,536. Whereas I'm going to put in $100. I actually have to put in a lot more. I do pretty well. I'm almost where she's at. I got $19,798, but look how much I have to put in is $13,000 and only about $6,600 of interest that I've earned. Now, this is all hypothetical, of course, and as it says here, this assumes consistent monthly saving until the child is 18 and an annual investment return of 7%. I cannot speak to, because again, I'm not a market person, but Fidelity does this for us and gave us these estimates, and they're sure that this is a reasonable estimate. So using that as the return on investment over that time, this is what we're looking at. So even though I'm doubling my amount, and I still start saving pretty early, child is in 2nd grade, it doesn't come close. It doesn't really match what Julie's able to earn as far as interest is concerned. No, ultimately we're pretty close. But just show you the power of starting early and using compound interest. Any questions on anything so far that I haven't answered yet? I'm about to move into the final sort of segment here, which is how families pay for post-secondary education. And so I don't know if you want to guess how much college is going to cost. Everybody has a sort of, I think, idea in their mind of how much a year of college is. I don't know if you want to take a minute and just put that amount into the Q&A, what you think a college may be. I kind of spoiled it a little bit here because I've got different types of colleges. And that is kind of the point that I want to make. And you'll see when we get to this, that how much college is really depends on the kind of college. It's very, very common. It happens every year around August. You're going to see news stories that college now costs at this particular college. What are we up to now? Maybe $75,000, $80,000 a year. I'm not here to tell you that college can't be that expensive or that it isn't. that expensive at these colleges, that somebody's not telling the truth. But the reality is more complicated than that. First of all, you should know that they pick the highest tuition and fee figure in the area to trumpet that. And this is before financial aid. And so these are my 2 points. So this data here is taken from a College Board publication called Trends in Student Pricing. At least most of it is, where they sort of survey all the different types of different colleges throughout the country, all the colleges throughout the country, and by state and by type, and sort of, average out how much college is going to cost. So those colleges that are on the news or in print are the most expensive options, which are typically the 4-year private colleges. And so, we have a lot of these in Massachusetts and the New England area. This is a national average number. So 1 year, tuition, fees, housing, food, books, supplies, transportation, all the expenses included for 1 year, 4-year private college, averages out nationally to be about $67,670 per year. So in the Massachusetts or New England area, we're higher than that. So, we may be higher than that. We have a lot of colleges and a lot of expensive colleges here. But this is the national average. So that's your most expensive option. However, there are other types. So 4-year public colleges have lower costs, especially if you are attending a public college in the state that you live in. So if you attend a public college in the state that you live in, you are eligible for a discounted tuition figure. So if you're an in-state student going to a 4-year public college, the average for that, the average cost, including all things, is about $27,940. So you can see a huge difference already in cost. Now, if you go to a 4-year public college outside of your state of residence, you're going to lose that tuition discount in most cases. But that still averages out to be significantly less than a private college, so about $46,240 per year. Now, again, this assumes that you're paying all of these things, and you may not be, right? So you might not be living on campus. So in that case, food and housing wouldn't be part of your expenses. Tuition and fees are what they call direct expenses. They're billed. That's what they are. Tuition, housing, food, books, supplies, there's going to be some variability there. This next category, vocational schools, this does not come from the College Board. They don't survey vocational schools. This comes from value colleges, university, community college, or trade schools. It's hard to tell because there's so much variation in different vocational programs. But this is the best figure I could find is less than $33,000 for the entire education. So these are certificate training programs for careers that don't require degrees, but they do require certifications. There are a lot of these. So, less $33,000 may sound like a lot, but again, remember, this is the entire education, whereas these first two are per year. But it's difficult, again, to say sort of uniformly how much these things may cost. And then finally, what's almost always the least expensive option are the 2-year public community colleges. And these average out to be about $9,620 per year, because that doesn't include food and housing. Most community colleges don't offer that. None in Massachusetts, I believe, have food and housing. They're all commuter colleges. So the average student, it averages out to about $9,620 per year. Now, again, main point, a lot of different types of colleges, big variation in cost. Second point is this is all sticker price. So this is before financial aid, right? And as I said before, the vast majorities of families will be eligible for some level of financial aid. To give you an idea, about $174.4 billion in aid was awarded to students in 2021-2022, and that's not really inconsistent with the figures I've seen over the past 10, 15 years or so. So that's a lot of money that's given out. And it comes in as I said, two varieties: merit-based aid, so that's scholarships. A lot of scholarships, most scholarships come from the colleges themselves. So that's gift aid. It does not have to be repaid. Academic scholarships, athletic scholarships, things like that. Most of that money, though, most of the $174.4 billion is need-based financial aid. So it's based on the family's financial needs. So you might have heard of programs like the Pell Grant program, which is a federal program, or these federal student loans that have benefits associated with them that are not there with other types of loans. These are examples of need-based financial aid. Other grant programs, financial aid from the states and from the college is counted in this as well. So that's a lot of money that's granted every year in financial aid. Most students will not be asked to pay the full sticker price of college. So how do families pay? First of all, maximize your financial aid, apply for all the financial aid, apply for scholarships. That should be the first thing that you do, accept all the aid that you get. And then once financial aid, accept all the aid that you want. Once you accept your financial aid offer, there's basically three ways to pay: past income, present income, and future income. So past income means your savings. Any savings that you may have, any gifts from relatives, anything like that, anything you can pay out of pocket and put down against the bill. Present income, I'm thinking about, this really refers to the money that you're making while your student's in college. Now, I don't know many, if anybody, who can pay just the tuition of a year or a semester from the money that they have left over after all the other bills are paid and they're working. But it is worth it to pay what you can out of pocket. Colleges offer monthly payment plans. Not everybody knows this, but they will go through an outside provider. And for a small fee, you can get on one of these plans. And if you decide that you can afford to pay, I don't know, $300 a month against tuition, well, over 10 months, that's going to be $3,000. And all that money goes against tuition. So let's say you get a bill for $20,000. You could borrow that $20,000. People do. But it is worth it to pay what you can other ways before you get there, right? So let's say you have $5,000 of savings that you can put down. Okay, well, now you got a $15,000 balance. And then you decide that you can afford to pay $500 a month over 10 months. Okay, that's $5,000. Now you decide that you can handle a $10,000 loan, $10,000 student loan or educational loan. This is important, even though $10,000 is still a lot of money to borrow. Sort of, back of the envelope math suggests that if you're borrowing $20,000, your monthly payment is going to be somewhere around $200 a month. So if you're borrowing $10,000, it's going to be somewhere around $100 a month. And most student loans have a 10 or 15-year repayment. So, okay, $100 a month, $200 a month. But this is only year one. So if you're going through 4 years, if you're borrowing $200 a month, that's $800 a month for a monthly payment after all said and done. Whereas if you're borrowing if you're borrowing $10,000 a year, paying $100 a month, that's only $400 a month. So once you get past income and present income, the only thing that's left is future income or loans. And it's not that borrowing is bad necessarily. You just want to be really mindful of the monthly payment that you're going to be paying for years after the student graduates. And also consider this, that, we talk a lot about student loans in the country. That really leads a lot of people to believe that students can just borrow whatever it is that they might need. If they have a $20,000 bill, then the student can borrow $20,000 and just pay it back after they graduate. Most of the time that doesn't work, because students can borrow on their own, in their own name, without a credit check, only for the federal student loans. And those have loan limits associated with them. So students can only borrow $5,000 a year as freshmen, or $5,500, $6,500 for sophomore year, $7,500 for junior year, $7,500 again for senior year, which is great. But that's part of the financial aid offer already. So if you get a balance after that, any loan that you get is going to have to be approved based on credit. And most students, of course, if they're 17, 18, 19 years old, do not have the credit necessary to be approved on their own without a co-applicant. So typically that means parents act as a co-applicant for students. And if a parent is a co-applicant on a loan, they are equally responsible to repay that with the student. So what I mean by this is that it's going to matter to you a great deal whether or not you're, if you're a parent, whether or not you're paying back a $100 a month monthly payment for one loan versus a $200 a month monthly payment, because you've got 4 years, you're responsible just like the student is for this. And just think if you have other children as well, not just one student. So it is worth it to pay what you can out of pocket, save, use monthly payment plan before you start borrowing. I want to leave you with that. So what you can do now, if you have not started saving for college, you can save now. You can talk to your child about college, about different costs of college. It's really important actually to talk about the cost of college and talk about what your capabilities are in terms of cost and where students can expect to, look at colleges and what kind of expenses you can take on as a parent. That I wouldn't say don't apply to more expensive schools because you are going to be applying for aid. Just make sure you have a balance and make sure that the child knows that cost is going to be a factor when you're looking at colleges. I think in the space of no conversation, a lot of anxiety and a lot of expectations build. And that's not a great place to be. You can use online tools to learn more about college costs, like the ones that we went over. We also have other tools and other content on our site, MEFA.org. Take a look at our webinars, our upcoming webinars on MEFA.org. This is College Savings Month, so we'll be having more videos and presentations and space for conversation about college savings. And our social media, where we post a lot of information about scholarships and different things, is right here. So Facebook, Instagram, Twitter, X, LinkedIn, YouTube, and our podcast. Now, I'm here to answer any questions that you may have, if there are any. We're a small group, I know. If you don't have any, good luck. I'll be hanging out here for another minute. Thank you for coming. Okay. Thanks, everyone.